Good morning. It is Friday, December 3rd, and this is the 0DTE morning market analysis where we look at the market situation for our 0DTE trades. And as you may already know, and if you don't, we trade 0DTE on the SPX and other indexes like the NDX, as well as futures like the E-mini S&P futures or the NASDAQ futures. And on occasion, we'll even trade crude oil or gold or other similar things. But they're all have expirations 5 days a week, so that's a wonderful thing. Our analysis every morning is to create a situation and figure out three fundamental things. And that is, what is our risk assessment? And we do that by looking at volatility so that we can determine how exposed or how contracted that we want to be to the current volatility. And then we're looking at market direction because we are directional traders. We're trading out of the money butterflies, so we can put on asymmetric trades, very small risk with large potential return. And then we look at our market structure, looking for levels, and we analyze the volume profile to determine where our potential entry events are going to be. So we do those three things every morning. And we also talk about a particular focus each morning. And this morning, I'm going to talk about why we choose the directions or the widths, not the direction, the widths of the butterflies we do. And as I said, it was all based on our exposure to risk and where volatility is and where the edge is. And volatility and our adjustment to that is really one of our primary edges. Of course, we have three edges, and that is the change in time, the change in price direction, and the change in volatility. Sometimes all three are going our way. Sometimes one or two are diminished, and so we have to figure out how we adjust to that in order to maximize the money we put at risk. So what I'm going to do is I'm going to first go through our three things that we do every morning so we can get that out of the way, and then we'll talk about why we select various widths on our butterfly. All right, and so let's start by going to the three fundamental things that we look at. And first at volatility. This is the VIX. It's a daily view. You can see we're going all the way back to 2021. Not necessary to go all the way back to 2021, but the reason why I have that all up here is so that we can see our guide and how I have it printed here. And once we've determined all of these factors, that tells us precisely what we're going to trade in the morning. We take our trades in the morning session between 9:30 and 12:30. That's where you're going to have the most opportunity and get the best pricing because of volatility or the flatness of volatility decay for that day. We can see that the VIX is at 17.84, which is a bit above our 17 level, which sort of the line of demarcation between what we call zombie land and Goldilocks zone. It was a little higher this morning, if I remember correctly, but in any event, that's where we're at. And so if we go over here to the left, it will show us what widths that we should be considering. So we're not quite in the 10 to 20 wide and maybe closer to the 20 to 30 wide fly. So we have to choose a fly somewhere between 20 and 30 wide. All right. And then the next step is to figure out, well, what side of that range should we be on? And we do that by looking at the expected move. But the way we look at expected move is a little bit different than maybe other people are doing it. We look directly at a specific option, and that is an at-the-money butterfly early in the morning before economic reports come out. We call that the big-ass fly, and depending on what its debit is, a low debit would imply high implied volatility for the day, and options will be priced appropriately. A very high debit would imply very low volatility. And so that would tell us what side of that range to be on, and that's what this guide is up here. So we're going to be looking at Goldilocks 1 because that's the range of widths that we're looking at, and we're going to see where the debit is. So let's go to Thinkorswim, and we'll take a look at our big ass fly, which is a 50 wide fly, as I said, and currently it's below 20. So there's a fair amount. That's relatively low on an average day. Average days, particularly in a low volatility environment, tends to be a little bit higher than that, usually above 25, around 30 or so. So the market's anticipating a fair amount of activity and energy coming into the market, and so it's priced a little bit lower. So let's see what that looks like on our chart. So low 20s, 20 or lower is on, in between 25 and 30 wide. So there you go. There are your choices, 25 to 30 wide this morning. So we're right here. Now, when we have a big ass fly that's less than 25, we also consider that as one of our edge case trades. And so that same butterfly, at the money butterfly, that which is an edge case. This is not our out of the money butterflies. It's not our asymmetric trades, but this is a special 0 DTE trade where we're looking to capture premium right after that economic report gets released at 8:30. And when it's below 25, the trade is on. And what I mean by that is that the debit is low enough, and the potential profit in that fly is high enough, the gamma is low enough. All the conditions are right to get a nice little volatility crush event after those economic reports are released and make a quick profit before the market opens, sometimes as much as 20-25% of the total risk that you put on. And after the reports and after the open, if price stays within the profit tent and near the center strikes, then we might even stick with that trade, and then it starts premium starts decaying even faster, and the value of that fly will grow, and so then we'll manage that as a 0 DTE trade. And usually we can take that right through to the morning session, and sometimes make 2 or 3 times the profit if we hold on to that trade. Now that happens probably half the time that we take the trade. Most of the time we get out early with a quick profit. All right, so that's where we're at right now with volatility. The next thing is to look at price direction, and we can see we're still moving down in this lower right-hand chart. We're clearly moving down. We're below the moving average. This is the Hull moving average, and it's showing it's also sloping down. So our out-of-the-money flies, we'll be looking at put flies. So we know our width, 25 to 30 wide. We know the direction. It's going to be out of the money put fly. The next thing is to look at what are the entry opportunities, and that's based on levels where we're going to find support and resistance. Are we on top of a node? Are we in a node? Are we below a node? Are we in a low volume node or not? How's the price likely to act? And because we're looking at a put fly, we're looking for price to move down for the day like it did yesterday, and move up into one of these structural levels, and that will be our entry event. We, as I said, we take those trades in the morning, and that's what these vertical lines are. They're masking off the 9:30 to 12:30 morning session. And so that's what we're waiting. And then I have these little pads that are at the intersection of those levels. And if you go back to some of our other charts, our other morning analysis, I've done an extensive talk about how we actually determine those levels. We go into a lot of detail. If you look back on my YouTube channel, I have literally hundreds of videos that talk about how I determine structure and so forth. If you want to learn more about that, you can go to our 0 DTE Academy. It's a school community, and the link's in the description. But anyways, we're waiting for an event that looks something like I don't know, moving up to here. Let's see. I didn't get the tool right. There we go. So we're looking for something, a move like this. And so when something like that happens and it moves up to a structural level and we find that it finds resistance, then we'll put an out-of-the-money fly below it, because that's what we're doing today, a put fly below, and we'll manage that. Now, we had a really nice event like that happen yesterday with awesome profit-making potential, so it moved up into this structural level. This red line actually indicates it's at the top of a volume node, and it moved down quite a bit. So there was huge money-making potential there. It went right through the node, right through the bottom, and into the well below. But it has recovered since, and now we're back up into that node. I can tell because this green line is the bottom of the node, and this red line is the top of the node. So that's all part of my color schema. All right, so now that we know exactly what we're going to do, we know width, direction, and where our entry event levels are. And so now it's just a matter of waiting. But in the meantime, we can put on that big-ass fly. Now let's take a look at the focus for today, and we're going to talk about why we choose the widths that we do. And I'm going to do that by going to a little presentation that I have here. All right, so it's a little lesson in premium decay. As you know, that because we're zero DTE traders, we're hyper-focused on that premium decay over the life cycle of that very last day of expiration, the zero DTE day, hence the name of our service. And what you're seeing here is the typical weekly option and its premium decay, showing the extrinsic value of that option, how it decays over the course of its life. And its life is about 8 days. Well, it is 8 days. And you can see that premium starts pretty high and then slowly decays over the first few days, and then starts increasing pretty rapidly, and then on the last day it's falling off of a cliff. Now, this is a very normalized average view of what premium decay looks like. It's all over the place in reality, but when you average them all out, that's what it looks like. Now, how does that help us? Well, let's take a look at what can affect premium decay. Yeah, for some reason it's not allowing me to go to the second page. That's weird. Isn't that weird? All right, we have to resort to something else. Let's go to the original app that created it. I don't know why, but it's like everything's in between. Isn't that weird? So I have it as a keynote presentation. So we'll just use that. Sorry for the delay. Keynote. There we go. All right. So this is the premium decay over the course of its life cycle. And you can also see that, well, let's go to the next slide. So there are two things, well, there's one thing that's going to affect the rate of that decay, and that's volatility. And there are two different situations we should look at. Well, first of all, we can see that on that last day, this middle line here, you can see we have quite a bit of premium available for us to capture, and that's why we do the zero DTE. But during high volatility times, that premium decay is actually delayed. The rate of premium decay is delayed. And so on that very last day, we have quite a bit more premium, right? And during very low volatility times, the premium decay is accelerated. And so on that last day, we have much less. So we have a great range of volatility or premium that's available for us to collect. And that is essentially one of our biggest edges. And so when there's small amount of premium to collect versus a high amount, we have to adjust to that. But it has a much greater implication than just the amount of premium. That level of volatility is going to affect the dynamics of our trade, and that's really what I wanted to show you. So let's take a look at two butterflies and how this is a single option. Of course, a butterfly is made up of 4 contracts, 2 longs and 2 shorts. And when they're all put together, they present a very different view of that real-time premium decay. and how it's presented on in a profit and loss situation. So we'll take a look at two butterflies, one in low volatility, one in high volatility. And so that's what this picture is showing us. Same exact butterfly, put at the money in low volatility versus high volatility and at the same time of the day. And you'll see that in low volatility, we've had accelerated decay of premium, so that there's already a lot of the premium that was available at the beginning of the life cycle of these options has already been spent up because of that low volatility and accelerated decay. So there's much less profit potential, much more risk compared to high volatility over here. You can see that it's quite the opposite. We're sitting very high. That's the zero line, obviously, and we have a lot of profit potential and very little risk. And this is much like what we're seeing today, where volatility is elevated. It's not quite. This is sort of an extreme. It's not quite as elevated as I'm depicting here, but it's similar. Now, there's another aspect to this that's extremely important, and that is the sensitivity to price that we have in low volatility versus high volatility. In low volatility, if we have a 10-point move, say, we have a lot of sensitivity to price because that premium curve, or the real-time P&L, has a very steep slope on it. That's essentially your gamma, that slope. And so we have high gamma, high sensitivity to price in low volatility. And in high volatility, it's exactly the opposite. We have a very flat P&L curve, real-time P&L curve, and so our gamma is extremely low. The sensitivity of price is very low. So these two things are really the reason why we adjust our exposure to that volatility. In low volatility, that requires us to go to narrower flies. In high volatility, there's more premium available, less risk, and less exposure to gamma, or less price sensitivity, so we can go much wider. And that's exactly why we choose the widths on there in the beginning and look at the volatility, look at the big ass fly, and it really gives us a very clear picture of the appropriate width to apply for that current market. All right. So yeah, that's it. So hopefully that was instructive and gives you a big picture about exactly how volatility affects our options plays and why we do what we do. During low volatility times, we have narrower flies and they tend to go closer to the market. We don't price them we don't choose how far away to go to the market. What we're trying to do is we're trying to maintain a certain risk to reward as well. That's extremely important. That asymmetry is extremely important. And so for our out of the money flies, where we use an old maxim that I found when I was working on the American exchange. And I noticed that the options traders there were using what they call the 10% debit rule because they traded these out of the money butterflies. And so they would make whatever the width was of the fly that they were using at that time, they would make the debit only 10%. And when you set the debit at 10%, the fly can only go one place, right? Because you have to move it out far enough until you get a 10% debit or something close to it. So that gives you a 1-to-9 risk to reward ratio. So we focus on paying prices or a range of prices that will give us somewhere between a 1-to-8 to 1-to-12, somewhere in that range, risk to reward, because that asymmetric trade is going to help us control the volatility of our returns as well as our drawdown and our risk management. So that's why we do that. So we choose our width, we choose the asymmetry, we choose the direction, we have the entry set up. We're all good to go. Now, all that's left now is to put on that trade and then manage the profits. All right. So hopefully that worked for you. If you want to learn more about all of this, then in great detail, our entire strategy, as well as be with a community of traders, have all your questions answered, etc. Go down below, select the the link for our Zero DTE Academy. It's only $35 a month. There's a huge library of content there, and it's always growing, and there are live events, all sorts of things, plus the community. It's a fantastic resource, and for the price of a cup of coffee a day, it's incredible value. All right, that's it. Thank you very much. I hope everybody has a great weekend. Coach Ernie out.